So for litigation, claims, assessments, three of the big things that have to be taken into consideration on whether or not to accrue, disclose, or ignore potentiality is one, what time period in which did the action occur? Did it happen in the time period in which the balance sheet is reporting? So did it happen before the end of the year, or did it happen after, so it's going to go into the next year? The cause for litigation has to have occurred on or before the date of the financial statements. This goes into the concept of periodicity and tying things to the period in which they occurred. What is the probability of a favorable or an unfavorable outcome? Now, some of that is a bit like looking into a crystal ball. So often case, that probability may not 100% be determinable at that exact point in time. And is there an ability to be able to reasonably estimate the loss? This is something that does not actually often happen until the later part of a suit. What you will do as an organization is that you will continue to be in consult with your lawyers and attorneys over litigation that may be occurring. Now, if there has not been a filed suit, there are unasserted claims or assessments, probability and the degree of probability that those will convert to a suit has to be determined. And then again, the probability of whether or not that would be an unfavorable outcome. So one of the things that really is interesting is that back in the day with the Ford Pinto Nova, I can't remember which one it is off the top of my head, with the original suits on the cars that blew up, there was assumed that there was going to be a high probability of a favorable outcome, not an unfavorable outcome, and that loss would be negligible. Unfortunately, as a result of that litigation, that became something of a landmark case, and the probability of the favorable outcome was not a true rendition of that litigation. Additionally, the amount of estimated losses that were tied to that particular claim were far beyond the reach of what anybody would have estimated at that given point in time. So that's why there is the ability to make a reasonable estimate of the loss. You don't want to mislead financial statement users by accruing an amount that is far less than what would actually be experienced. Thus, going back to the attorneys and the lawyers and utilizing their knowledge and information is paramount when determining loss contingencies related to litigation's claims and assessments. The second type of contingency that is often one of the ones you will see probably in most companies is guarantee and warranty costs. So warranties are promises made by the sellers or the buyers to make good on a deficiency of quantity, quality, or performance in a product. Companies can provide and often do one of two types of warranties. There's the assurance type warranty, and then there's the service type warranty. What a warranty does is that it entails future costs to the organization. So after making the sale, something goes wrong. Something's broken, it doesn't perform to expectations. The company will incur a cost to make that good. However, there is no way through our crystal ball to say Sally Joe's item is going to be defective. So we have to do a lot of estimation on this. And we'll talk about that further in depth here in just a little bit. The first type of warranty is the assurance type. That is that the product is going to meet an agreed upon specification in the contract at the time that the product is sold. This is really just a quality guarantee on your products, and the obligations tied to these should be expensed in the period in which the goods are sold or the services are provided. And then we would have a corresponding liability. Let's take a look at a situation with an assurance type warranty here. So Denson Machinery Company begins production on a new machine in July 2017. They sell 100 of those machines for $5,000 cash by year end. Each machine is under warranty for 1 year. And Denson estimates, based on past experience with similar machines, that the warranty cost will average $200 per unit. Additionally, as a result of parts replacements and services performed in compliance with machinery warranties, it incurs $4,000 in warranty costs in 2017 and $16,000 in 2018. So the question is, what are the journal entries for the sale and the related warranty costs for 2017 and then 2018? To start with, let's look at the journal entry to prepare and record the sale of the machines and accrue the warranty liabilities for July through December 2017. We received cash of $500,000. We estimated $200 per machine, or $20,000 in warranty expenses that would be associated with this revenue. We accrue the corresponding liability to those sales. And then we recognize our sales revenue of $500,000. Now, sitting in this warranty liability account will be amounts including and up to any other warranty expenses that had not yet been incurred. So for those warranty costs incurred from July through December of 2017, we'll do an entry offsetting the warranty liability. So that's $4,000 of costs that we have seen, and then crediting cash, inventory, payroll, whatever means in which we fulfilled that warranty. Now, the third thing we needed to do was to prepare the journal entry to record payment for warranty costs incurred in 2018 related to our 2017 machinery sales. We incurred another $16,000 in warranty costs. So we reduced the warranty liability by $16,000. And then we have the offset to the cash, inventory, payroll that contribute towards fulfilling those warranty claims. So at the end of January 2018, there is no liability for warranties for machinery sold in 2017 because we accrued $20,000. In 2017, we consumed $4,000 of it. In 2018, we consumed the other $16,000, so it would be at zero. The other type of warranty is a service type warranty. This is a warranty that provides an additional service beyond the assurance type. We record this as a separate performance obligation. And it is going to be typically recorded in an account called unearned warranty revenue. We will recognize revenue from this on a straight line basis over the period the service type warranty is in effect. A service type warranty is a warranty such as those extended warranties that you may purchase when you purchase large appliances or vehicles. And what they say is that beyond the assurance type warranties, so that first 1 year or whatever that the manufacturer warrants the product free from defects, that there is an extension beyond that. And you purchase that extension separately. So with that extended period is what you're purchasing. So you are paying today $50,000 additional, $50,000, that's a lot. My apologies. Say $5,000. And that $5,000 is going to cover 4 additional years. While you, as the consumer, have paid up front, you now have the right to 4 more years of coverage. Over those 4 years, that revenue will be recognized by the manufacturer as that time expires. So let's look at an illustration of a service type warranty. So you purchase an automobile from Hamlin Auto for $30,000. They estimate the assurance type warranty costs on the automobile to be $700. Hamlin will pay for repairs for the first 36,000 miles or 3 years, whichever comes first. Then you purchase for $900 a service type warranty for an additional 3 years or 36,000 miles. Hamlin incurs warranty costs related to assurance type warranties of $500 in 2017 and $200 in 2018. They record their revenue on their service type warranty on a straight line basis. So we're going to look at the entries related to these that Hamlin has to make in 2017 and 2020. So first we have the entry to record the sale of the automobile and the warranties. So the automobile was $30,000. The service warranty was $900. So they received cash of $30,900. There is a warranty expense tied to the assurance type warranty of $700. There's the liability for the assurance warranty of $700. And then we recognize unearned warranty revenue of $900 because that revenue does not come into play until the second period of time. Remember, it's 3 years or 36,000 miles, whichever occurs first, is covered underneath the assurance type warranty. So that's our warranty expense, and our warranty liability is tied to that. Then after that time period passes, then the second warranty kicks in. And at the time of sale of the automobile, that hasn't been earned yet by the automobile company. And then $30,000 for our sales revenue. So let's look at our journal entry to record our warranty costs that are incurred in January 2017. So from January 2nd to the December 31st, 2017, there were claims on the warranty of $500. So we reduced the warranty liability by $500. And we offset our cash, our inventory, our payroll, however we fulfilled those warranty claims. Now, fast forward to the first year in which the service warranty comes into play. Remember, it's 3 years or 36,000 miles, whichever comes first. So 3 years later, we are now in the first year of the service warranty. Because we're running on straight line basis, we take the $900 that was paid for that service warranty and divide it by 3. That means for each year, it's $300 in revenue. We reduce our unearned warranty revenue by $300, and we move it to warranty revenue of $300. Now we're going to talk about something a little bit different, where you may or may not have experienced warranty claims as the consumer. What you probably have experienced is consideration payable. So a lot of companies have frequent purchase programs, buy 10, get one, after your 10th cup of coffee, you get a free cup. Buy 10 energy drinks, get your next one free. The Unwich, or I can't remember the name of the company now. It eludes me, of course. It'll come to me at the worst moment. But Sandwich Company has one of those cards that you punch, and then you have a free sandwich. As a part of doing business, as a marketing tool, companies will use all kinds of different ways where they're going to give a discount, a rebate, free products, free services. These are called premiums, essentially, to their customers. When this happens, when a company has one of these types of marketing ploys, plans, or whatever you want to call it in place, they should charge the costs of those premiums and coupons to expense in the period of the sale that benefits from the plan. Companies have to estimate the number of outstanding premium offers that customers will actually present for redemption. So what happens is that there's a coupon or there's an expiration date in there, box tops, labels, wrappers, all of these different things. Thousands and thousands of them will come out, but not all of them will come back to the company for redemption. So the company has to estimate, based off experience, the number of those that will actually come back and be a cost to the company, and charge those costs to their premium expense and create a premium liability. Both warranties and coupons are loss contingencies that do satisfy the conditions that are necessary for recording a liability. Remember that the income statement and the expense recognition principle requires that companies report related expenses in the period in which the original sale occurs. So let's look at Fluffy Cake Mix Company, who sells boxes of cake mix for $3 per box. So in addition, they offer their customers a large, durable mixing bowl in exchange for $1 and 10 box tops. This used to happen all the time with all kinds of manufacturers. Your grandmother or great-grandmother may have an entire collection of dishes that are the result of this. The mixing bowl costs Fluffy Cake Mix $2. And then the company estimates that customers will redeem 60% of the corresponding box tops. Premium offer began in June 2017. During 2017, Fluffy Cake Mix purchased 20,000 mixing bowls at $2 a piece and sold 300,000 boxes of cake mix for $3 per box. And they redeemed 60,000 box tops. So let's start looking, and let's prepare the journal entry to record the purchase of 20,000 mixing bowls at $2 per bowl. We would have a premium inventory of $40,000 offset by the cash used to purchase it. Now we have to determine what the premium expense to this period is and what the premium liability will be. So we have total box tops that were sold were 300,000, and we expect a 60% redemption. That gives us a total estimated redemptions of 180,000 box tops. The cost of those is 180,000 divided by 10 because we needed 10 box tops for redemption. We multiply that by $2 minus 1, and that gives us $18,000 of estimated redemption. So we will have our cash received of 900,000. That is the actual sale of the boxes of cake mix. We'll have a premium expense of 18,000, sales revenue of 900,000, and the premium liability of 18,000. Now, when we come into the point of actual redemption of the consideration payable, remember, it was 10 box tops and $1. We'll receive $6,000 in cash, because there are 6,000 instances, or 60,000 box tops. We'll reduce our premium liability by 6,000. And then we'll reduce our premium inventory by 12,000. The December 31st, 2017 balance sheet of Fluffy Cake Mix would have premium inventory on hand of 28,000 as a current asset and a premium liability of 12,000 as a current liability. They'd have 18,000 of premium expenses as part of their selling expenses on their 2017 income statement. Now let's just take a minute and go ahead and peruse this little article on frequent flyers. Frequent flyer miles are a lot of things that happen with many of the major airlines. As you can see, the importance of actually accruing these liabilities has materiality to the financial statements when you think that there has been reported liabilities of over $4.2 billion for frequent flyer tickets for Delta Airlines alone. Now, last but not least, we're going to talk about some environmental liabilities. These are very important because they are where the company is going to recognize what's called asset retirement obligations. This means that there is an existing legal obligation associated with the retirement of a long-lived asset, and when it can be reasonably estimated the amount of the liability. AROs should be recorded as fair value. When do these occur? Obligating events and some examples of those, but by no means are these the only ones, are things like when a nuclear facility needs to be decommissioned, dismantling, restoring, and reclamation of oil and gas properties. That should hit pretty close to home for most of us here in Western Colorado. The closure, reclamation, and removal costs of mining facilities. Again, that can hit very close to home for many of us in Western Colorado. And then closure and post-closure costs of landfills. All of these have a potential environmental impact, and there's usually some legally binding type of obligation that requires that these particular types of things, when they come to an end, then have to have the land reclaimed, or it needs to be reclaimed and improved. All of this will tie back to some of the original permitting, state laws, local municipalities. And remember that this needs to be done at $1 of fair value. So on January 1st, 2017, the Wildcat Oil Company erects a platform in the Gulf of Mexico. They're legally required to dismantle and remove the platform at the end of its useful life. That useful life is estimated to be 5 years. They estimate that the dismantling and removal alone will cost $1 million. Based on a 10% discount rate and the fair value of the asset retirement obligation, it's estimated to be $620,920. We're taking into account the time value of money. So we would have the ARO as drilling platform of $620,920 with an asset retirement obligation offsetting that. Now, during the life of the asset, Wildcat is going to allocate those retirement costs to expense. They're pairing the expense with the revenue it generates. So utilizing the straight line method, December 31st, 2017 through December 31st, 2021, there will be a depreciation expense associated with the asset retirement obligation of $124,184 and an offset to the accumulated depreciation for that account. In addition, Wildcat must accrue interest expenses each period. And those interest expenses and the increase in the asset retirement obligation on December 31st. So we have the interest expense, $620,092 multiplied by the 10% of $62,092 that particular period. And it increases the asset retirement obligation by $62,092. Now, eventually, Wildcat's going to contract with rig reclaimers to dismantle the platform at a contract price of $995,000. So at the point of settlement, they're going to have $1 million come off of the asset retirement obligation. They're going to have the gain on settlement of the asset retirement obligation of $5,000 and a payout of $995,000. Now, this last loss contingency is just very small. It's called self-insurance. A lot of companies actually are partially self-insured or completely self-insured if they have deep pockets. This is not actually insurance. What it is risk assumption on behalf of the organization. There is very little justification for the establishment of a liability based on the hypothetical charge to an insurance expense. What you will often find is footnotes and disclosures related to self-insurance.